Sampath Reddy joins in on the show right now from Bajaj Allianz Life Insurance. Sampath, hi, afternoon. Good to have you on the show. Sampath, I guess history teaches us that any geopolitical tension, if not closer home, acts as a buying opportunity for the market if you do see a knee-jerk reaction.
That's right. That's right. And yeah, historically that has been the case, for any reasons, whether it's geopolitical or even any other reasons, market corrected sharply. I think they ended up becoming a very good buying opportunity. I think even currently also, we've been slightly cautious in the initial part of the year, but I think as we move ahead, the earnings growth is catching up quite well. There was a bit of a worry in terms of overall valuation side, even with the kind of earnings growth one is seeing. Even the valuations are also now sort of if you look for 1 year further ahead, looking at a comfortable level. Only challenge is that the interest rate side. About a year back, we all believed that by now mostly the interest rate would have been in a declining trend, but that's not what is happening. I think the higher for the longer, the narration is slowly getting built in, and I think that's what is happening on the interest rate side. I think market has to factor in this as well. The higher for longer is even today the longer in the sense market is probably believing that couple of quarters of longish period. But it looks like that what I hear and read from from the experts, the longer in the sense it could be much longer period in term beyond couple of years or so. So if interest rates were to stay elevated for a much longer period, then we have to see how will the valuations behave. It looks like that there could be a risk to the valuations overall if the interest rates were to remain higher like this for a longer period of time. That was the only worry. But I think the geopolitical issues, especially from an Indian market point of view, I would think that we are much less vulnerable now, even in the back of the crude. Also, our relative the impact would be much less given our strong macro fundamentals. So overall, I think the geopolitical issues have not become cause of worry, but I think the interest rates, going forward, higher for longer is a little bit of a cause of worry in terms of overall valuations.
So what's the best investment strategy right now? Should one look at domestic facing sectors, maybe financials or consumption?
I think the domestic facing sectors have been currently doing much better, especially the financials with credit growth quite robust in upwards of 15-16%, and the NIMs also expanded quite well. And also if you look at the asset quality, one of the best asset quality which the banks are sitting on today. So overall, even the valuation front also the the BFSI spaces, I would think much more attractive vis-a-vis its own valuation that we had seen in the past. So overall, and all fronts, domestic, the financials look quite good. And overall, if you see the export-oriented sectors, especially the IT, we are still facing challenges in terms of overall growth. That's why I think the domestic-facing sectors are much preferred. But within the exports, I would think that especially the pharmaceutical export, the generic pharmaceutical exports, that segment continues to do well. So I would not say that all exports are not good, but especially the the generic pharmaceutical exports, there which we were struggling from a pricing point of view, that pressures are now behind. So that generic exports are also looking good, and certainly the domestic facing consumption-oriented sectors continues to do well.
Right. Okay, that's the take coming in on the market right now. The other thing, Sampath, of course, in continuation with the domestic trend is what's happening within the real estate sector. The fact that the realty index itself is at a 15-year high, most of these stocks, of course, making a fresh high, pretty much across the board. Wanted to get your sense whether the markets have already priced in the growth that the sector may actually post next 5 to 10 years.
I think the real estate sector, especially from the post-COVID lows, have recovered very well. With most of the companies are now going back into the work from office mode. I think the demand for the office space is also improving quite well. Even though we don't have really much of an exposure to the real estate sector per se, but I think overall the market for the real estate is also looking quite good. And some of the better way to play. I think, from our point of view, we are looking at more of a REITs as an investment income rather than really looking at stocks there. We really don't have much of an exposure to the direct real estate stocks, but I think in that space overall, the REITs is a better model for people like us. Yeah.
This is a good model to play that entire real estate trend as well. So you don't have much exposure to real estate, but where have you been adding exposure? Which sectors, apart from, let's say, financials, are you adding weights on?
Yes, yes. The financials we've been quite, I would say, invested quite well. And apart from that, as I was mentioning, the generic exporters, pharmaceutical exporters, we've also been adding quite well there. And also industrials, we've been having a decent amount of exposure in industrials and auto space. By and large, the most of the domestic facing consumer sectors, or even the capital goods and infrastructure space, we are reasonably exposed. I think only probably the IT is where there seems to be headwinds in terms of the current in the very near term perspective. By and large, I think our focus has been largely towards domestic consumption oriented sectors or domestic even infrastructure growth oriented sectors. That's where we largely been adding.
On that note, we'll let you go. Thank you so much for joining us.